The risk would be lesser because they're already the market leader. The risk would be lesser because when opponents or competitors try to attack them, they would be harder to beat because they have a large moat around them. And as what we talked about earlier, brand is a moat. Being a household name is a moat. Being the top 1, 2, 3 in that particular category also is a moat. So the harder the competitors can come in to be able to beat them, the more predictable they are. Hey guys, so in this video, let's talk about blue chip stocks. Are they worth buying right now in the midst of all of that's going on? As you do know that there's a lot going on in the States that people are saying that they're gonna enter into a recession. But prior to all of that, we've seen stock markets around the world, in Western shores, and even in the Philippines drop massively. And even we've seen indices or even individual stocks move very, very close to where it was when we saw countries, cities locked down due to what happened at the start of the pandemic more than 2 years ago. So in this video, I'm gonna answer a question that was sent out via YouTube. This was sent by Arlene Espinazo, and she's asking this: Sir, are the blue chip stocks worth buying this time? Do you still have a recommendation? Let me pull up a Google search on what blue chip is. So based on Investopedia, a blue chip stock is a huge company with an excellent reputation. These are typically large, well-established, and financially sound companies that have operated for many years and have dependable earnings, often paying dividends to investors. A blue chip stock typically has a market capitalization in the billions, is generally the market leader or among the top 3 companies in its sector, and is more often than not a household name. For all of those reasons, blue chip stocks are among the most popular to buy among investors. Some of these examples, and they're giving US examples: IBM, Coca-Cola, and Boeing. I really believe that blue chip is a very, very subjective term. The example I would give, it's just like calling someone pogi, and calling someone pogi or handsome or guapo or good looking is something that's very, very subjective. And just looking at the definition here of Investopedia, it actually points out that it's very, very steady in giving out its dividends. But if you try to look at it also in the way dividends are structured, normally the ones that are giving out very, very good dividends are the ones that are not growing as rapidly anymore. And that's the reason why they could give out good dividends, because the company is already mature enough, which is very, very true. When people talk about blue chip, it kind of sounds like something that's very subjective. But one thing that's true from what we've looked at now from this Investopedia definition, they talked about huge company, excellent reputation, large, well-established, financially sound, operated for many years, dependable earnings, gives dividends, high market cap, market leader, top 3 companies in its sector, more often than not a household name, or it has brand. This paragraph is describing is a combination of 2 things from a school of thought called fundamental analysis: qualitative and quantitative analysis. And the very reason why I don't use the term blue chip in the way I would analyze my stocks, because I would always tell people, focus more on the fundamentals based on what your plan is on why you are buying that stock. Meaning, if you are a growth investor, then focus on the fundamentals that you need to look at that would make that company a good growth stock. Or if you are the type of investor that's looking for cash flow, when you are looking for a company that's giving you stability, it also means that it may not give you that excellent growth anymore. It may not give you that amazing growth anymore, that amazing gains anymore in terms of them trying to get a bigger piece of the market, because they've already done it. The reason why they're stable, because prior to them becoming stable, they've already done the work. They've already grown so much. That's one of the reasons why they're top in their category, they're top in their market. That's why they're a household name also. When you try to analyze stocks, there will always be a trade-off. The ones that are stable, the ones that you know are predictable, the ones that are household names already, are the ones that won't give you massive amounts of gain anymore because they've already grown a lot. On the flip side, companies that have a larger narrative to grow may not be the most stable ones, because as they're trying to grow, they're probably challenging a current market leader, or they're probably trying to develop a new market that hasn't been done before, or they're probably expanding in a new category. And you know what that actually means? When they're trying to do all of that, there's a larger amount of risk involved. That what if they possibly lose? What if all their plans trying to beat the bigger competitor expand to a new category or go to a new area. What if it doesn't pan out? What if they actually lose in the process? What if all of the money that they spent, the money that they raised in order to make this all happen, is all for nothing? It always goes back to some of the principles that I would talk about in the videos talking about personal finance. The higher the risk, the higher the return. The lower the risk, the lower the return. Companies that will give you stability are companies that won't give you amazing amounts of growth or amazing amounts of earnings, but it can give you also cash flow. Because the reason why they're stable is they can also give you dividends because their earnings are already predictable. In the same way, growth companies may not give you even dividends, because one of the reasons why they are growing, every time they earn money, they pump it back into the business. They pump it back into what they need to do in order for them to become bigger, better, stronger, and probably the number of stores that they need to put up, the areas where they need to expand require more capital. That's why they're not actually giving dividend. There are opportunities right now, and I've made videos about that also. Check out the videos prior to this. What are the opportunities in the Philippines? What are the opportunities also if you want to position right now when everyone's scared? However, you must segment it based on the fundamentals of the company. You must segment it also on what your plan is. You must segment it also. Are you the type of person that's looking and coming into the stock market for growth? You don't care if you get cash flow, you don't care if you get dividends, but all you want is you want to position early, you want to position cheap, you want to position when everyone's scared, and then later on when the markets turn, because you're buying something that has the ability to grow massively more, that's when you reap the benefits. In the same way, if you are a passive cash flow type of investor, then it makes sense buying something that's stable. It makes sense buying something that's a household name. It makes sense buying something that the risk would be lesser because they're already the market leader. The risk would be lesser because when opponents or competitors try to attack them, they would be harder to beat because they have a large moat around them. And as what we talked about earlier, brand is a moat. Being a household name is a moat. Being the top 1, 2, 3 in that particular category also is a moat. So the harder the competitors can come in to be able to beat them, the more predictable they are. You can also apply whatever we're talking about to Philippine stocks, Singapore stocks, to US stocks, because principles like this, especially in fundamentals, it will work regardless of the market. To answer the question that was sent by Arlene, I really don't follow the term or the subjectiveness of what a blue chip stock is, but I do agree all of the wordings, the principles that describe what a fundamentally sound company is. You just have to separate it. Fundamentals for growth, fundamentals for cash flow / capital preservation, because that's the way you could do it. And if you notice it also, it's not a one-size-fits-all strategy because it's so hybrid. Even if you analyze fundamentals, what are you gonna use? PE ratio to determine if it's cheap, or PB ratio to determine if it's cheap? Or what are you looking for? Are you buying it based on the growth of the dividends, or are you buying it based on the growth of the net income, or are you looking primarily based on revenue? Or are you the type of person that's looking at it from a macroeconomic perspective, that this is where the cash flow is going, this is where earnings are headed? Even though if valuations wise it's expensive, it's more premium, but because I know the company's good and it's right smack in the middle where all of the money is headed, then this company will take advantage of it. Use fundamentals more. You don't have to look at the terminologies, because at the end of the day, if the company is performing well and you position properly and you're willing to actually wait, especially right now, no, I always say this, that when every time it's scary and your timeline is long and you're deploying capital that you don't plan to touch for a very, very long period of time, times of uncertainty are times for accumulation. Times of uncertainty, if you don't fear the volatility, should be times to build and stack a base. The ones that are doing the opposite are the ones that would reap the benefits later on. Please do remember this. When times are good and everyone wants to come in, the market is high, the market is expensive, and your upside is limited. When times are bad, things are pessimistic, there's downside, and when you enter, there's still a possibility that it could go lower. But in the longer scheme of things, your upside becomes massively bigger. It's the one who makes calculated positions, that's studied well, not just blindly optimistic, not just hoping for the best, but the ones that position out of the merit of the fundamentals of the companies are the ones that will do well. Just to close this, Arlene, if you're looking at Philippine stocks, they don't change as much. The ones that are well run 10 years ago. Up until now, they're well run. You can watch it, how those companies that were so good pivoted in the pandemic, that they even became more profitable or they even did well. Because in good times, even bad companies can do well. But in bad times, that's where good companies become bigger, better, stronger, that will elevate them to become great. In the midst of what's going on, focus on the fundamentals, stack, build a base. If you want to learn more about fundamentals, 3 ways. Number 1, hundreds of videos down below. Number 2, a webinar. It's recorded. You can sign up. You can watch it anytime you want. And number 3, I've written books about it, talking about the stock market, talking about fundamentals, talking about buying a good company at a good price. If you want to know more about that, links are in the description below. And here's the thing, if you made it this far and you appreciate videos like this, it would be amazing if you could like, share, and subscribe, and smash the bell so you get updated every time I come up with new content about investing. It really helps the YouTube algorithm push this video forward. But above and beyond that, I'm here to give you as much value as possible. So if you guys have more questions similar to what Arlene did, put it down below. I'll try my best to read it. And if it's something that I believe will benefit a lot of people, I'll make videos on that as well. That's it for now. This is Marvin Germo. I hope this video helps you. Trade well, trade strong, trade smart. See you all again soon, and God bless you all.